As expected, the global economic outlook is becoming less bright. The International Monetary Fund, the IMF, has recently published its new forecast for the global economy. In those figures, one can see that the IMF is expecting a lower growth rate for the global economy, so that means for the developed as well as for the developing countries in 2019. Nevertheless, 2020 will become a better year again. This is consistent with the KBC economic scenario. We also expect that 2019 will be a weaker year, but that gradually the global economy will recover. In particular for the euro area, we expect a growth rate of 1.1% only this year, but gradually next year that figure will become much better. A recovery in the European economy is very much depending on recovery in the German economy. In Germany, the economy was distorted by a number of internal factors, like for example distortions in the automotive production, as well as by some international headwinds, in particular Brexit and the international trade war that is going on between China and the US. Currently we get some mixed signals for the German economy. Some of them are negative, some of them are positive. Among the negative ones are the sentiment indicators that still point to a further deterioration, especially in manufacturing sentiment. Among the positive factors, what is definitely good news is that the German export sectors are clearly performing quite strongly, despite all these international headwinds. Nevertheless, the recovery in the German economy will depend on what's happening at the international stage. As far as Brexit is concerned, there is actually good news. The European Commission and the British government decided to allow more time for the British Parliament to approve of the withdrawal agreement with the European Union. Although this will increase the period of uncertainty regarding Brexit and caused by Brexit, it is good news because ultimately there is a higher probability that there will be a soft Brexit, an orderly Brexit with a clear deal and a clear situation what will happen once the UK will leave the European Union. As far as the trade war is concerned, there is positive as well as negative news. The positive news is coming from the negotiation table. China and the United States have been negotiating a trade deal for a while, and although they won't solve all their trade disputes, it's quite likely that they will reach a deal to create a bit more stability in their relations in the near future. This is also good news for the open European economies that will benefit, for example, from a recovery in the Chinese economy. The negative news is coming from the White House. President Trump is threatening higher tariffs on the European economy because of the recent crashes of some Boeing airplanes. There is a decennia-long conflict between Boeing and Airbus, and typically when one of the two companies is under pressure, this might lead to more and new trade disputes, also in other sectors. Hopefully this trade conflict can be avoided. Obviously there is still the risk that the American government will launch higher tariffs on European cars. So the probability that there will still be a trade conflict between the US and Europe is still relatively high, and it might distort our economic forecasts. As economic growth forecasts are revised downward, also inflation and inflation expectations are coming down. For the euro area, in March, we noticed that inflation dropped till 1.4%. The core inflation even dropped to 0.8%. This is exceptionally low and probably partly driven by seasonal effects, in particular as Easter is relatively late in 2019. Nevertheless, the European Central Bank is acting on this economic information, and we confirm our scenario that we expect the European Central Bank to raise interest rates, the policy rates, only in 2020, so not in 2019 anymore. We expect the European Central Bank to increase the deposit rate from -40% to 0% by the end of 2020. Also, the long-term interest rates remain under pressure. The German 10-year Bund rate even dropped below 0%, which is really exceptional and even theoretically hard to explain. Nevertheless, we expect the German 10-year Bund rate to remain very low for a while. In particular, since so many international headwinds are still there, so many risk factors will still affect the economic scenario, we expect that the German interest rates will only go up to 0.30% by the end of this calendar year. And also for the next years, we expect the German long-term interest rates to remain relatively low. At the same time, we also notice that European spreads, the interest differential between German interest rates and other European countries' interest rates, remains very limited too. In particular for some core EMU countries like Belgium, France, but also for Portugal and Greece, we notice that interest rates have come down again. And the interest differential with Germany is really very small. All of this signals clearly that in bond markets, investors are clearly believing that there are so many international risk factors that they try to shelter in these bonds at this moment. Also at the other side of the Atlantic Ocean, the economic outlook is worsening. American economic growth is predicted to be substantially lower this year compared to last year. Obviously, last year was an exceptionally good year for the US economy, thanks to fiscal stimulus by the Trump administration and also thanks to some anticipation effects in the trade conflict with China. Nevertheless, we expect that the American economy will slow down not only this year but also next year. So that means basically that the rebound that we expect for the European economy won't be there in the US economy. This is not really a surprise, given that the American business cycle is already going on for many years, will actually be the longest business cycle in June this year ever. And therefore, it's quite natural that the American economy will continue slowing down this year and in the next years. Despite the growth slowdown, the US economy is still doing very well. Actually, if we look at the labor market, we see that there is still substantial job creation and wages tend to go up. So all of this might give support to consumption and actually also to economic growth. At the same time, we see that American inflation is a little bit subdued, which might explain why the Federal Reserve is becoming more cautious in its monetary policy. We no longer expect the Federal Reserve to increase interest rates. Instead, we actually believe that the Federal Reserve might lower interest rates for the first time, actually, and this will happen in the beginning of next year. So that would definitely signal that the Federal Reserve might try to stimulate the American economy again. To summarize, the global economy is still in good shape. Nevertheless, the economy is slowing down this calendar year, but we expect that there will be a rebound, a gradual recovery later on this year, which will ultimately lead to a better economic performance next year. The low inflation is definitely causing challenges to central bankers, so it's quite unlikely that interest rates will go up quite quickly, and that holds for the short run as well as for the long-term interest rates. Generally speaking, the real economy is doing very well with strong labor market performance, investments still doing very well. So all of this basically provides still a very fertile soil for financial markets.